Oracle Corp, ticker symbol ORCL, is currently trading at $186.24 a share. This stock has been on an absolute tear. If we look year to date, it is up 78%, and if we were to compare it to the S&P 500 over a similar time, which is up only 28%, it has easily beaten the market. Even if we look at a slightly longer horizon of 5 years, market is up 92%, Oracle is up 240%. So is this the right time to buy? What we're going to be doing is looking at my automated stock valuation spreadsheet and then giving a fair value of Oracle using the discounted free cash flow model, comparable company model, dividend discount model, and the Ben Graham formula for intrinsic value. So if I put in the ticker ROCL, this will load up all the latest company financials for Oracle and we can have a deeper dive. So as I said, $186 a share, market cap of about $500 billion, 516 billion. P ratio is a little high, 48. Market average is currently 31.11, which has actually gone up recently. Earnings per share, $3.88, and a beta of 1.03, meaning it is only slightly more volatile than the market. And analysts say it's about fairly valued, target price of 184. Dividend-wise, they pay a 0.87%, meaning you would get paid $1.62 per share. Dividend is very safe, 4.5 billion, and it's about 40% on the free cash flow payout ratio and the net income payout ratio. If you want to get paid the dividend, buy before the 10th of January 2025 and you'll get paid your quarterly dividend. So here we have the numbers here, but let's have a deeper look. Revenue, all-time highs, 54.72 billion. You can see it's had pretty good years since a certain something happened in 2020. They were quite flat for a number of years, but they managed to grow the revenue in the last 5 years quite nicely. Are they able to generate more profit out of that revenue? Well, it's a bit of a mixed bag here. Not all-time highs, just shy of 11 billion. They haven't quite topped that 2021 number, but they are generating more revenue, as we saw, but not as much profit as they previously have. Free cash flow, are they generating more free cash flow? Similar story to the net income, 11.27 billion. They have increased it recently since 2022, but they've had sort of a consistent 10 to 13 billion free cash flow apart from that number in 2015. Now, if we do look at the operating cash flow, this is where it's a slightly better story. Operating cash flow has increased over the last few years. CapEx is up, so free cash flow is operating cash flow minus CapEx. This gives you the free cash flow, but we can see the CapEx has increased, but the operating cash flow is going up, which is a very bullish sign. Shares outstanding, what they're doing? Well, they were buying back shares quite aggressively, but they have issued some more shares in 23 and 24. So let's have a look at the discounted free cash flow model. This is a way of valuing companies, looking at their future free cash flows and discounting them to today's value. Let's have a look here. So we currently have a calculated stock price for $110 a share. Let's have a deeper look at these numbers. Revenue estimates, we're estimating 58 and 61 billion. Let's see what analysts say and if we're in agreement. 58 and 65 billion. So what we'll do is we'll bring these numbers up just a little bit slightly. We'll bring it up to about, we'll go 7%. That puts us at $115 a share. Net income margins, pretty happy with this number, 21%. I mean, even if they would increase it a little bit more, brings us to about $120 a share. Now, the net income to free cash flow, I think the 2024 number is really bringing this down. So we'll just take an average of these three here. That is 132. We'll go 130. And still, yeah, $133 a share in terms of discounted free cash flow ratio. But as you can see here, these ratios are quite high, 102 and 47. If you're interested in this sheet, please check my Patreon. I'll talk about more at the end, but yeah. So we'll look at the dividend discount model quickly. They have had pretty good dividend growth, although some years they don't. The average growth is quite high, but you can see here with the weighted average cost of capital about 8.8. They need to really grow their dividend quite a bit for being undervalued. It's a very small dividend, a small payout, but still interesting for some investors. Ben Graham formula for intrinsic value. This is a way of valuing stocks, which was created by the godfather of value investing himself, Ben Graham. It looks at the earnings per share, AAA bond yield, PE of non-growth companies, and looks at the day now. Unfortunately, which makes this number less, is the AAA corporate bond yield is 5.14%, meaning that Ben Graham will like these stocks less and less. High inflation environments means Ben Graham doesn't like it. So Analysts are expecting 13% in the next year. So even if we go a bit more on the bullish side, still puts it at, see, $78. Now, if this was 4%, it'd be 100, 3%, but it would need to be quite low for it to be there. So Ben Graham doesn't like the stock either. So finally, discounted free cash flow doesn't like it, dividend discount model doesn't like it, and Ben Graham formula doesn't like it. But let's have a look at the comparable company model. This is a way of evaluating companies looking at their competitors, and then we can see if it's a buy or sell. What we're looking at here is revenue growth rates, EBITDA, net income, profit margins, price to sales, price to book, PEG, Peter Lynch's price to earnings growth, and then the metrics here are EV to revenue, EV to EBITDA, PE, forward PE. We take averages of these and see if it's a buy or a sell. So first, we'll put in Microsoft. Obviously, a lot bigger than this company, but I think it is worth having it as sort of a benchmark to compare against. Another ticker symbol is SAP. Let me just see if this is in. Okay, cool. And then CRM, Salesforce. I did a video on them the other day. So in terms of enterprise value, Oracle is the second largest behind Microsoft, 3 billion, 600 billion. Second highest in revenue as well. Not one of the highest revenue growth rates. Salesforce is actually higher than Microsoft, than Oracle. EBITDA, second highest. Net income, second highest. Profit margin, second highest as well. And there you go. See, price to sales, one of the lower ones. Price to book, very high. PEG, second lowest. EV to revenue, EV to EBITDA, PE. Has one of the higher PEs, but with Salesforce and CRM. Higher than Microsoft, obviously, but Salesforce and SAP is higher, so that gives us an average of 240. In terms of EV to revenue, it is the second lowest, 126, and EV to EBITDA, second lowest, and EV to revenue, the second highest. So implied share value based on these averages, $150 a share. So none of the models are saying there's a buy. It is looking like even like Microsoft probably is better. Don't know why it hasn't loaded the forward P for Microsoft. That's quite strange, but we'll just ignore that. But yeah, so none of the models interestingly do say it is a buy, but as I said before, this stock has been on an absolute tear this last year. It would have to go back to prices that is not seen in about 6 months. Now, if we compare to Microsoft over that time, it's actually done a lot better than Microsoft. Microsoft up only 20% over year to date, 20% again, 5 years, even beating Microsoft over 5 years. So a lot of the growth may be already in Oracle, but been a good company recently, but yeah, I think maybe at a bit of a high valuation at the minute. Right, guys, thanks for watching. Please give a like on the video if you enjoy it. Subscribe if you're not already. Check out my Patreon, and I'll catch you guys next time.